Welcome to this week's market drama. We'll begin with the S&P 500, which was down 0.2%, so essentially flat. It is now up 2.5% year to date. NASDAQ was down a little bit more, down 0.5%. It is now up 1.1%. And if we look at year to date, the market is up, but is not driven by what has driven the rally the last couple of years. Financials are up close to 8% for the year, while tech is down 1%. Tech has not recovered from the news of DeepSeek and what that meant for all the AI driven stocks in the tech sector. They've come back some, but it really has not been able. They have not been able to bounce back to the levels they were prior to the announcement of DeepSeek's new models. So the stocks end lower, but it's not really about tech. It really was about tariff uncertainty, right? So stocks on Monday opened down 2% in response to the prior Friday's announcement from President Trump, stating that the U.S. would implement 25% tariffs on imports from Mexico and Canada, and then 10% levies on China imports. Now, by the end of the day on Monday, President Trump did postpone those tariffs on Mexico and Canada for 30 days, and that did provide some relief for stocks all the way through Thursday. And on Friday, the market sold off a bit, and there's a couple of things going on there. One is kind of heading into the weekend, there were some concerns that there would be new imposed tariffs. But when it comes to actual news, on Friday, we did have jobs data come out. And when it comes to the job data for the prior month, it did go below expectations. It did come in at 143,000 jobs. The expectations were 175. However, when you look at the last 2 months of job gains, they were revised higher, bringing the 3 month average to 241,000, which is above the 165K average we saw over the last 12 months. Also, the unemployment rate dropped to 4%, which is well below the long-term average of 5.7, and it dropped below the expectations, right? The expectations were at 4.1%. So kind of a mixed bag there when it comes to the front month. But when you look at the broader trend, employment is holding up, right? And if you look at average hourly earnings, they ticked higher to 4.1%, which was above the expectations of 3.8. That's kind of good news, bad news. Good news is that hourly wages are growing faster than inflation, right? Which is good for the consumer, and the consumer drives 68% of the economy. Bad news is that when you look at wage growth, it does tend to affect service inflation, right? So it kind of puts pressure on inflation to move up higher. When it comes to earnings, now about 60% of the S&P 500 has reported earnings, and 77% has exceeded expectations, which is above the 10-year average of 75% of companies exceeding expectations. We had a couple of headline companies like Amazon not perform as expected, but broadly speaking, earnings are holding up. And as you've heard me say many times, earnings is the biggest driver for the stock market. Of course, earnings don't come in a vacuum; they're tied to the broader economy. But companies are delivering and are forecasted so far based on their earning expectations and guidance to continue to perform. If that continues, that ultimately drives market returns outside of obviously the multiples assigned to those earnings. So what do we have in store next week? We have CPI inflation data as well as retail sales data coming up. So stay tuned for those ones. Have a good one.